If you recall, this time last year, markets was pricing in a Federal Reserve liftoff in the third quarter of 2015, and our expectations were for a 25 basis points hike in the fourth quarter of this year. We see this as a distinct possibility for December, although this is a difficult call, as 2015, as you would note, has been a year of volatility and general pessimism. Worries of an emerging market growth crisis has been a focus of financial markets' attention, and this was exacerbated by a number of China's policy missteps in an effort to maintain market stability, particularly stock market stability. Now, as for Latin America, there was great concern amidst the downward spiral of commodity prices, and also, as you note, in countries like Brazil, there was deteriorating country fundamentals. Such considerations would have been on the minds of the Fed when they decided to leave policy on hold in September. Global factors and downward pressures and inflation were cited as their near-term concerns. Now, we note that the prevailing bearish market sentiments, but we are inclined to take a more optimistic view. US economic growth has been on a moderate upward trajectory with diminishing labor market slack and a steady improvement in consumer sentiment, as well as in the domestic housing market. Eurozone economies have also been expanding at a fairly healthy clip, as you can see from the rise in the Purchasing Managers' Index. In emerging market Asia, concerns have been mainly over the outlook for China. We anticipate that the ongoing stabilization of China's property market, the government pursuing a moderately expansionary fiscal policy, and consumer spending holding up well would enable the economy to see growth strengthening into 2016. In this environment of a moderate global recovery, the Federal Reserve, we feel, can afford to pick up the pace of its tightening in 2016, although the gradient of rate increases is likely to be fairly moderate. Against this benign macro backdrop, Asia bond markets should be able to mitigate the negative impact of measured rate increases, albeit with some near-term volatility. This is because it is helped by its attractive bond carry. We view a sharp deceleration in global growth as a potential key risk, which could result in a severe market volatility for emerging markets and Asian assets. What has been ailing global capital markets in 2015, particularly for emerging markets, has been the weak oil and commodity price outlook. Depressed energy prices, we feel, cannot be sustained for an extended period, as these cheap levels should invigorate consumption. If our expectations for a moderate global recovery comes to pass, we should see global growth strengthening further, which will lead to a potential turnaround in commodity prices. Now, this could usher then a 6 to 12 month period where Asian emerging market bond markets and currencies see a period of recovery from the battering it took in 2015. Apart from global bond carry, gains in Asia local currency bonds could be supported by better currency performance. Asia currency valuations have significantly improved following the steep corrections seen this year. In Asia, hard currency bonds also offer value because credit spreads have widened in the third quarter of 2015, and these will bring about good opportunities for investors. A hard landing in China is often seen as another key worry, but as I've mentioned, this is not our central view. Overall, Asia continues to be well placed in terms of macro fundamentals relative to the rest of emerging markets, and they will benefit from a moderate global growth backdrop. Nevertheless, return expectations need to be weighed against the impact of a less favorable interest rate cycle in the US. Fragilities do remain in the region, and close attention to their development is warranted to assess their impact on our base case scenario.